If you've got £150,000 in your pension pot and you're planning to take regular UFPLS payments from age 55, there's a 2-year gap nobody told you about. From the 6th of April 2028, the normal minimum pension age rises from 55 to 57. UFPLS is not protected the way drawdown is. Take one payment before that date, and you cannot take another until you turn 57, no matter how old you are in between. Someone who turns 55 in March 2028 and takes a single UFPLS payment could find themselves locked out of their own pension for up to 23 months. Most people assume that once they start taking money at 55, they can keep drawing year after year. That assumption is about to catch a specific group of people badly off guard. HMRC published provisional guidance on this in June 2026, and buried inside it is one detail that separates the people who will be completely fine from the people who are at genuine risk. That detail is the difference between drawdown and UFPLS. I'm going to show you exactly which side you want to be on before the deadline and exactly what to do if you're not there yet. The difference between those two groups comes down to one decision that needs to be made before the 6th of April 2028. If you're in that 55 to 56 window or know someone who is, and you don't want to lose 2 years of access to your own pension, hit subscribe now. I'll walk you through the exact steps to make sure you're on the protected side of this rule. Say you have a £200,000 pension pot. You take a single UFPLS payment of £15,000 in March 2028. You needed the money, you took it, you paid the tax. After the 6th of April 2028, the remaining £185,000 is locked. You cannot take another penny from that pot until you turn 57. HMRC's provisional guidance confirms it. UFPLS payments made after the deadline are only lawful if you are already 57 at the time of the payment. This was not made explicit until June 2026, and the consequences are bigger than most people realize. For someone who turns 55 in early 2028, that could mean a 23-month gap in income from their own pension. 23 months where the money is there, invested, visible, potentially growing, but completely untouchable. That's the number buried in this guidance, and it's the number that changes how you should be thinking about UFPLS right now. So what is actually changing, and who does it affect? The normal minimum pension age is the earliest age most people can access their personal pension. Since 2010, it has been 55. From the 6th of April 2028, it rises to 57. The legislation has been in place since 2021. This is not a surprise arrival. What is new is the Transitional Protection Framework that HMRC published in provisional form during June 2026. For the first time, it sets out clearly who retains access through the change and who does not. The affected group is people born between the 6th of April 1971 and the 5th of April 1973. These are the people who turned 55 in the 2 years before the deadline. If you turned 55 before April 2026, you are not in the affected window. By April 2028, you will have already turned 57. If you won't turn 55 until after the 6th of April 2028, you'll simply wait until 57, like everyone born after April 1973. If you're turning 55 between now and the 6th of April 2028, this directly affects you. Here is how the protection framework works. If you have already designated your funds into flexi-access drawdown before the deadline, payments from that crystallized pot can continue afterwards, regardless of your age. If you are already receiving a lifetime annuity or a defined benefit pension before the deadline, those payments continue too. The rules were designed to protect people who are already in a recognized, ongoing income arrangement. The gap, and this is the trap, is UFPLS. An uncrystallized funds pension lump sum is a one-off crystallization event. Each payment is treated as a new transaction, not an ongoing income stream. HMRC's technical pension guidance is clear on this. Drawdown annuities and defined benefit entitlements all sit within the transitional exceptions. UFPLS does not. Take one payment before the deadline, and the rest of your uncrystallized pot waits for your 57th birthday. If you've been following the standard advice, draw your tax-free cash at 55, take income via UFPLS as you need it, you are not wrong to have done that. You were doing exactly what the industry has been saying for years. But the rules have changed, and UFPLS users did not receive the same transitional protection as drawdown users. That distinction was not communicated clearly. The system, to put it plainly, is designed to favor ongoing income streams over ad hoc lump sums. Flexi-access drawdown is the quiet winner of this change, and there is a very practical reason for that. So if UFPLS is the trap, what is the way through? Most people in this window don't realize that by crystallizing your entire pot into drawdown before the deadline, you can keep full access to your money without any gap, even if you're still 55 or 56. Let me show you exactly how that works. Here is the key insight that HMRC doesn't put in the headline. If you crystallize your entire pension pot into flexi-access drawdown before the 6th of April 2028, your whole fund becomes a protected income stream. You can take whatever you need, whenever you need it, from that crystallized pot, even if you're only 55, and that access continues after the deadline. No gap, no lockout. Let me show you what that looks like with real numbers. Assume you have £180,000 in a defined contribution pension, no other pensions. You're turning 55 in early 2028 and you need regular income. Path A, you use UFPLS. In March 2028, you take £15,000 as a lump sum. On the 6th of April, the remaining £165,000 is frozen. You cannot access it again until you turn 57 in 2030. That is a potential 2-year income gap. The money is there, invested, but out of reach. Path B, before the deadline, you crystallize the full £180,000 into flexi-access drawdown. You take 25% as tax-free cash up front, that is £45,000. The remaining £135,000 goes into drawdown. From the 6th of April 2028 onward, you can still draw from that £135,000 at any time. It is taxable as income, but the access is fully preserved. No gap, no wait. The difference is not marginal. Path B avoids a forced 2-year income interruption and keeps full flexibility over the crystallized money. The £45,000 tax-free cash also gives you a buffer outside the pension if the market moves against you in the short term. The mechanism behind this is straightforward. Uncrystallized money is governed by the normal minimum pension age rules. Once you crystallize, once you convert those funds into an active drawdown arrangement, you have done the thing the rules require. You're in the recognized income stream. The door stays open. I'll be honest with you. For years I thought UFPLS was the simpler, more practical approach for smaller pots. On paper, it often is you take what you need when you need it, and only part of each payment is taxable. That logic made sense. But after working through HMRC's June 2026 guidance carefully, I have completely changed my view. For anyone in this 55 to 56 window, full crystallization into drawdown is the safer decision. The simplicity of UFPLS is not worth a 2-year income gap. If you have a single defined contribution pot and you are planning to access it before age 57, there is one question to answer before April 2028. Do you want to crystallize now and preserve your access, or do you want to risk the lockout? For most people near this age, crystallizing early is the obvious answer. The harder question is how to make it happen in practice, and that is what we are going to look at next. Let me put this into real terms. Meet Peter. He's 55 in January 2028. He has a £200,000 defined contribution pension pot. He plans to retire at 55 and draw £18,000 a year from his pension. He lives in Manchester, owns his home with a small mortgage left to run, and has done everything sensibly. His plan is entirely reasonable. But he hasn't thought about what happens if two things go wrong at once. Picture the first quarter of 2028. The FTSE 100 falls 15%. Peter's pot drops in value from £200,000 to £170,000. Unprepared Peter, the one who planned to use UFPLS, takes £18,000 in February 2028. After the 6th of April, his remaining £152,000 is locked. He cannot access it until he turns 57 in January 2030. That is 21 months. He needs to pay his mortgage. He needs to cover monthly bills. He cannot draw from the pension. He either returns to some form of work, dips into savings, or takes on debt. The market has fallen. His pot is smaller than expected, and he has no access to it for nearly 2 years. Prepared Peter, the one who crystallized into drawdown in November 2027, looks completely different. He took 25% of his original £200,000 pot as tax-free cash, that is £50,000. The remaining £150,000 went into flexi-access drawdown. After the market falls in early 2028, his drawdown fund has lost value alongside the market, but it remains fully accessible. He can draw his £18,000 a year as normal, paying income tax on it but receiving it. He also has the £50,000 tax-free cash as a buffer. The drop hurts him too, but it does not cut off his access. Now add a second pressure. Peter's partner needs a hip replacement. The NHS waiting time is 18 months. Private surgery costs £12,000. Unprepared Peter already used his one UFPLS payment before the deadline. The pot is locked. He cannot access it. He has to wait for the NHS or find £12,000 from somewhere else. Prepared Peter can draw an additional £12,000 from his crystallized drawdown within a few working days. He pays income tax on the withdrawal, but the money is available. I am not saying the market will fall. I am not saying you will face a sudden medical bill, but these two scenarios show what the rules actually allow and what they don't. Drawdown preserves the option to act. UFPLS, after one payment before the deadline, removes it entirely. For context, ONS figures suggest the average defined contribution pension pot at age 55 in the UK is around £88,000. The numbers in these examples are larger, but the principle is exactly the same at any pot size. The gap, the loss of access, is just as real whether your pot is £88,000. Now, if any of this sounds like your situation, I want to address something before we get into the practical steps. Because the first obstacle most people run into isn't practical, it's psychological. And unless you deal with that first, the steps don't actually land. The most common reaction to this change, I see it in comments, I hear it in messages, is anger. It's my money. I saved it. The government shouldn't be telling me when I can have it. That feeling is entirely real. If you're angry, you are not alone. I've heard from people born a day or two too late, furious that plans they've spent 30 years building suddenly look different because of a rule change. You saved under one set of rules. The rules moved. That is a completely legitimate grievance. But here is what anger does not do. It does not change the date. It does not change HMRC's guidance. And if it stops you from taking the one action that protects your access, crystallizing into drawdown before the deadline, then the anger is working against you. The shift that actually helps is a change in the question you're asking. You cannot control the normal minimum pension age. You cannot control your date of birth. What you can control is what you do with your pension pot in the next 21 months. The moment you crystallize into drawdown before the 6th of April 2028, you move from someone affected by the rule to someone who anticipated it. That is worth more than holding on to UFPLS out of principle. Instead of asking why this happened, ask yourself one question. What is the single most useful thing I can do before the 6th of April 2028 to protect my access to my own pension? For most people in this window, the answer is the same: crystallize the pot. One conversation with your provider. One form. One decision that removes 2 years of uncertainty. That is the whole move. But before you pick up the phone, there are a few things to check first, because not all providers make this straightforward, and some may even tell you that UFPLS is still fine. Let me walk you through what to actually do. Let me start with a recent example. A viewer I'll call Susan, 56 years old, from Bristol, spoke to a pension provider not long ago. The provider told her she had nothing to worry about with UFPLS. She'd already taken one payment. When she came back to them with HMRC's provisional guidance, the picture changed. The provider confirmed she would be locked out of further UFPLS after the 6th of April 2028. She only found this out because she asked the right question. Most providers won't bring this up themselves. Don't wait for them to. Here are the 5 things to do before this rule comes into effect. First, check your date of birth. The affected group is people born between the 6th of April 1971 and the 5th of April 1973. If you turned 55 before April 2026, you are not in the affected window. By April 2028, you will have already turned 57. If you won't turn 55 until after the 6th of April 2028, you will wait until 57 like everyone younger. If you are turning 55 between now and the 6th of April 2028, this directly affects you and the decision needs to be made now. Second, find out what your provider actually offers. Not all pension providers offer fully flexible drawdown. Some only allow partial crystallization. The question to ask is direct: can I crystallize my entire pot into flexi-access drawdown before April 2028? If the answer is no, or if your current provider does not offer flexi-access drawdown, you may need to transfer your pension to one that does. Pension transfers typically take 4 to 8 weeks from start to finish. If a transfer is needed, do not leave it until early 2028. Third, decide how much to crystallize. For most people in this window, the safest move is to crystallize 100% of the pot before the deadline. You do not have to take all the income right away. You can leave the crystallized money invested in drawdown and take withdrawals only when you need them. The key step is the crystallization itself. If you crystallize £100,000 before the 6th of April 2028, you can draw from it the following week, the following month, or a year from now. The crystallized status is permanent. Fourth, get your timing right. There is no benefit to crystallizing years ahead of when you need income, unless you need it now. But March 2028 is too late to be safe. Provider backlogs are expected to build as the deadline approaches. Aim to have this done by the end of 2027 or no later than the start of 2028. Fifth, get written confirmation. Once the crystallization is complete, ask your provider for written confirmation that your flexi-access drawdown account has been opened and that you can continue to access it after the 6th of April 2028. Keep that document. One more thing that catches people by surprise. When you crystallize into drawdown, you trigger what is called the Money Purchase Annual Allowance. This reduces your annual pension contribution limit from £60,000 down to £10,000 per year. For most people who are fully retiring or winding down near age 55, this is unlikely to matter. You probably won't be making large pension contributions. But if you are still working and planning to keep contributing to a pension after crystallizing, that drop from £60,000 to £10,000 is significant. Check your contribution plans before you act. Have you spoken to your provider about this yet? Drop a comment below and let me know which provider you are with. I want to know which ones are handling this well and which ones are still catching up. The headline is simple. UFPLS users in the 55 to 56 age window face a potential 2-year lockout after the 6th of April 2028. The solution is to crystallize your pension pot into flexi-access drawdown before that date. One action. It protects your income, your flexibility, and your peace of mind. I started this channel because UK retirement planning is full of rules that only reveal themselves when it is already too late. The difference between UFPLS protection and drawdown protection is exactly that kind of rule. Not hidden on purpose, but not clearly communicated either. My aim is to get this in front of you before the deadline closes in, not after. If you want to stay ahead of changes like this and not just react to them, hit subscribe. I'll be here every week with practical UK-specific guidance you can actually use. You have got time. The deadline is the 6th of April 2028. But don't waste it. Check your date of birth, check which method you're using to access your pension, and make a decision. I'll see you in the next one.